a Treasury divided by language. It began with a translation error, so small it went unnoticed for years. A single phrase, interpreted differently across borders, slowly split one treasury into competing realities. What one ministry believed it promised, another believed it controlled. And between those meanings, an entire financial system began to fracture. To understand why language mattered this much, we must return to a Europe governed by treaties written to unite rivals. Agreements were drafted in multiple tongues, each version declared equally valid. Diplomats celebrated the symbolism. Lawyers warned of ambiguity. But urgency overruled caution. Words were trusted to hold together what politics could not. The first reveal appears inside the Treasury's legal archive. Officials reviewing emergency funding rules discovered that the authority to issue guarantees depended on which language version was cited. In one, approval required parliamentary consent. In another, executive discretion was enough. Both were official, both were binding, and neither acknowledged the other. The second beat followed as policy diverged quietly. One side of the Treasury authorized support assuming temporary scope. The other treated the same action as permanent power. Funds moved. Obligations accumulated. Reports conflicted, yet appeared consistent within their own linguistic logic. No alarm sounded, because everyone believed they were following the rules. But beneath the surface, the Treasury was no longer unified. It was bilingual and divided, and as pressure mounted from markets demanding clarity, the system would soon discover that value cannot survive long inside a contradiction. The divergence deepened as the crisis intensified. Each side of the Treasury acted with confidence, unaware that the other was operating under a different interpretation of the same rules. Memos circulated that appear aligned but authorized conflicting actions. Guarantees were extended under one framework, then constrained under another. On paper, everything balanced. In practice, obligations stacked unevenly. As the reveal continued, auditors began noticing irregularities they could not explain through arithmetic alone. Numbers added up within departments, yet failed to reconcile across them. Requests for clarification returned answers that were technically correct, but incompatible. The problem was not fraud or incompetence. It was language, shaping authority in two directions at once. The conflict surfaced when markets demanded reassurance. Investors asked who ultimately controlled the Treasury's commitments. Officials responded with statements translated carefully, each version reinforcing its own logic. What was meant to calm uncertainty instead amplified it. Analysts compared text side by side and spotted the fracture. The Treasury was speaking with one voice, but in two meanings. Pressure mounted as rival institutions exploited the gap. Some sought guarantees under the more permissive interpretation. Others challenged restrictions, citing the stricter version. Legal teams argued past each other, each armed with an official text. The Treasury became a forum not of policy, but of translation. The buildup intensified when a major support program reached its limit. One branch declared the authority exhausted. Another authorized extension. Funds moved, then froze. Payments stalled. Confusion rippled outward, affecting banks, pension funds, and public services tied to Treasury flow. The contradiction had reached the real economy. Inside emergency meetings, the truth finally surfaced. There was no single Treasury policy anymore, only parallel ones sustained by language. Attempts to reconcile the text revealed that neither could be altered without admitting error. To choose one meaning would invalidate years of action taken under the other. The system had been split not by ideology or ambition, but by words. And words, once written into law, do not bend easily. The question now was no longer which interpretation was correct. It was how long a Treasury could function while believing in two realities at once. The fracture became impossible to contain when legal challenges reached the courts. Judges were presented with two equally authoritative texts, each demanding obedience. Rulings conflicted. One court upheld the executive's authority to extend guarantees. Another ruled the same action unlawful without parliamentary approval. Both decisions were correct within their own linguistic reality. The Treasury now operated under judicial contradiction. The conflict intensified as financial institutions reacted defensively. Banks suspended participation in support programs, unsure which guarantees would survive legal scrutiny. Pension funds delayed allocations. Municipal budgets froze projects midstream. The economy slowed not because money disappeared, but because certainty did. No institution could commit while the rules themselves argued. The build-up surged when an internal report leaked to the press. It revealed that senior officials had been aware of the translation discrepancy for years, but avoided addressing it out of fear. Clarifying the language would have required reopening treaties, renegotiating authority, and admitting that billions had moved under ambiguous control. Silence had been chosen as the lesser risk. Public reaction was swift and unforgiving. Citizens learned that their Treasury, guardian of stability, had been operating on a linguistic fault line. Protests erupted not over ideology, but over trust. How could obligations be honored when even the rules defining them disagreed? Confidence drained faster than any reserve could replace it. Inside the Treasury, panic sharpened into urgency. Emergency committees attempted to harmonize procedures without touching the underlying texts. Temporary guidelines were issued. Footnotes multiplied. But every workaround deepened the contradiction. The system was no longer strained. It was suspended between meanings. Foreign partners grew wary. Some reduced exposure. Others demanded explicit confirmation of which interpretation would govern future commitments. The Treasury could not answer without choosing a side. And choosing meant unraveling years of policy built on careful ambiguity. By now, the realization was unavoidable. Language was no longer a technical detail. It was a battlefield. And until it was resolved, every financial decision risked collapse through interpretation alone. The Treasury stood divided not by power, but by words. And the reckoning was approaching. The reckoning arrived not with a verdict, but with a choice no one could delay any longer. The Treasury could continue operating in ambiguity, risking collapse through contradiction, or could confront the fracture openly and accept the consequences. Silence, once protective, had become corrosive. The climax unfolded during an emergency reconciliation session convened behind closed doors. Legal scholars, translators, judges, and finance officials sat together with the original text laid side by side. Line by line, phrase by phrase, they traced how meaning had drifted. What emerged was uncomfortable but undeniable. Neither interpretation was wrong. Both were incomplete. Authority had been stretched across language without a mechanism to resolve conflict. The decision was historic. A single authoritative interpretation would be adopted, not by erasing the others, but by acknowledging their limits. The Treasury publicly declared which version governed future actions, and justice publicly accepted responsibility for past ambiguity. Some guarantees were reaffirmed. Others were renegotiated. Losses were acknowledged rather than hidden. Trust was not restored instantly, but clarity returned. The resolution unfolded over months. Treaties were amended with unified language. Translation standards were tightened. Financial law began treating language not as decoration, but as structure. Every future agreement carried explicit hierarchy clauses to prevent meaning from splitting again. The Treasury became one voice, not by accident, but by design. The damage left scars. Confidence had been shaken. Costs were real. But the system survived because it chose transparency over perfection. Markets adjusted. Institutions resumed planning. Citizens regained something more valuable than stability alone: understanding. This story left Europe with a lesson easy to overlook and costly to ignore. Money depends on rules. Rules depend on language. And when language fractures, value follows. So what do you think? Are we repeating the same mistake again? A